Walk through that about the different buckets idea, because that's always something that I've heard you talk about. Can you kind of flesh it out for us again?
Yeah, just think of it in terms of risk and when you need the asset, all right? So if I've got money that I need for a college fund and my daughter's in college, that money should not be as aggressively invested as if it's for a niece or nephew that might be 5 years old versus somebody in college, right? So you can take on more risk because you have more time. Same thing, if you have money that's set aside to buy a vehicle next year, you better not be taking the same risk on that as you are your retirement fund for 25 years from now. And so if we have the assets in the correct bucket, we'll call it, with the correct risk, yes, assets are going down, but you can weather that storm because you don't need it tomorrow. That's the piece of it.
So here's kind of an interesting question, and maybe this is just me being dumb or something, but it seems like when everything goes down this much, does the crowd know something more, that they're pulling out, all of this money, it's coming out and everything's crashing down? Does the crowd know something more? Because you hear these financial guys like you and the rest of them kind of saying, this is your time to buy, but why is it that the crowd all leaves really, really quickly and then you watch things? What does the crowd know that we don't?
Right. Well, good question. I don't know what they know either, right? The professional traders and things like that. Obviously, we were at some peaks. We're almost at Dow 30,000, and people took some profits off the table. But the four most dangerous words in investing is it's different this time. And if you just let that sit in your head, the media and the things that we read want to tell us it's different. And it is a little bit different. The sporting events being canceled, the kids not being able to go to track practice today after school. I mean, reality has hit us last week all of a sudden that said it's different. What's not different is the way the stock market is behaving. We're down 30%. We were down 50% in 2018. As of Friday's close, the last 12 months, the S&P 500, which is 500 large company U.S. stocks, was still up 1% for the 12-month period. But it's gotten killed in the last 2 weeks. And so a little bit what's been unprecedented is how fast this has happened. But we go through recessions, we go through bear markets, things like that happen, and I don't think that we can constitute because they canceled a Minnesota Timberwolves game or something like that as all of a sudden it's different. I think the people that this most affects, Matt, are the people that are in retirement or just getting into retirement. If you think about it, and we talk about this a lot, it's called sequence of returns. You and I have talked about it. If you have a mutual fund, let's just say, or an investment that's at $100 a share, and you need $1,000 to live on, you sell 10 of those shares, and you get your $1,000 for this month. If all of a sudden those share prices are worth $50 a share, now you got to sell 20 shares in order to get your $1,000 a month. Well, as you sell those shares, someday they're going to come back. But you're getting rid of too many shares. And so the people that are really will be hurt by a 30% decline in the market are people that are selling shares on sale. So you need to make sure that you have a strategy in place so that you're not doing that. And then it's the people that are getting ready for retirement that maybe haven't protected some cash. That maybe all of a sudden, just you pick a number, they had $500,000 in the market and today it's worth $430,000. And they're saying, well, now can I retire? Because they didn't protect some cash. So those are the people that should be the most concerned, and they should seek out advice and get in front of a financial advisor that can help them.